Hello, all my dear students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So today we are going to start with our most awaited video, that is the revision of 9 RTPs, 9 past papers and 8 MTPs, total 26 paper compilation we are going to start today. Now before we start with the compilation, I would like to say a few things before we start with our first paper. That is, the very first thing that I would like to say is, whenever I will revise this particular 26 papers, if you find any particular concept important at your end, just make sure that you put a timestamp below the comment box, so that when you want to recap the things, you can directly click on the timestamp and then you will directly jump to that particular section of the video. For example, if something is important at 53 minutes, just put 53:00 in the comment box, and that point, if you click, next time you will directly come to that particular section, so that you don't have to search that concept again. This has been very helpful for the students. There has been more than 1,300 comments on the video which we have uploaded in the last year. Most of the comments were about the timestamps only. This is the first thing. Second thing that I would like to say you all is regarding this PDF. This PDF I will share once I will upload the second part. Today I am uploading the first part covering 5 RTPs, and next day I will be uploading another part. Day after tomorrow. After that I will share the PDF. Later on, I will upload the compiled video of 26 papers together. Okay, at that time, I will give you the compiled PDF also of 26 papers at one PDF file only. Third thing, the most important thing that I would like to say before we start with our revision. Whatever we are going to do in this 26 papers, obviously we have done all these things in class, and in class we have done all these things in our regular batch, exam oriented batch, and even in our practical question batch in great detail. Here we are going to complete this particular thing as a revision in 8 to 9 hours, so that on the day of examination you are able to revise. But in the class, I have explained you each and everything in detail. So we have done all these things in detail, except the latest MTPs and RTPs which were not there available at the time of doing the classes. Except the latest MTPs and RTPs of May 26, rest all we have done in the class. So be careful that there should not be any confusion, that you should not ask me such questions, sir, if we do this, is it sufficient without doing the class videos? We are skipping the class. Don't do that. If you have a class video, then you do the class video first, complete that. That is in great detail. There I have explained everything in great detail. Suppose a question is completed over here in 10 minutes, there it is completed in half an hour. So just imagine the content that I have delivered over there. Obviously, for obvious reasons, that is class, there we have sufficient time. This is for revision purpose. We are doing this video only for from the perspective of, so that on the day of examination you should be able to recap it very fast. Last but not least, one more thing, that there are few more RTPs and MTPs and past papers which are covered in our textbook apart from all these. These are covered in our textbook. Apart from this, we also have, suppose here it is November 22. So in our class book, you will also get May 22. You may also get December 21. So like that, there are few more RTPs which are covered, which will give you more exhaustive coverage. Here we are covering 9 RTPs, 9 past papers, and then you are doing 8 MTPs. Okay, so these are the few things that I had to say before we start our session. Now I will not say anything till our last paper. I will only talk about the content. That's it. Now let us start with our first RTP, RTP November 2022. The very first question over here is on partnership form, and in this question, the partnership form, the examiner has asked us to compute total income and tax payable of the firm. Now, no remuneration is given in this question. Therefore, because remuneration is not given in the question, therefore there is no need to compute any book profit. Otherwise, in partnership firm question, you have to first compute book profit, then you have to compute remuneration, and then you have to compute total income. In this question, no remuneration, therefore no book profit. Directly compute total income. Let's compute the total income. The partnership firm is commenced. They have started with 3-star hotel. 3-star hotel is eligible for 3580, and this associate is claiming also 3580. Okay. Now this entity was set up in 2025. The firm has 2 partners, 2 working partners, and the net profit of the firm is 26 lakhs. Now let's start computing the total income. 26 lakhs is the net profit. The very first item over here is depreciation as per books of accounts, so add back. Second is interest on capital, 15%. 15% not allowed. Only 12% allowed as per 40B. Therefore, 3% add back. 3% will amount to 10 lakh, because 15% amounts to 50 lakhs. Therefore, 3% amounts to how much? 10 lakhs. Add back 10 lakhs. Third one is you have taken some loan from Mr. Rajveer, a resident, and you are paying him some interest on which TDS is not deducted. So, if you don't deduct TDS of residents, 30% of your expenditure will be disallowed as per 40A1A. Therefore, add back 30%. After doing all these things, the next point is, you are purchasing some fixed asset. You are purchasing one motor car for 7 lakh rupees, and you have capitalized the same in the books of accounts. So for this 7 lakhs, you can claim 3580 deduction, because you are using this motor car for what? For 3-star hotel. Second, you are also incurring some 2 crore rupees capital expenditure, but out of that 1.5 lakh crore is land. So land is not allowed as deduction under 3580. Therefore, you can claim deduction for only building. Land will not be allowed. Third, you are also purchasing some air condition on 15th of May for 3,20,000 rupees. So that also you can claim as a deduction under 3580. Now, if you do all these things, you will be under loss. Your 3-star hotel will be under losses. So now the question is, you have another hotel, which is a 4-star hotel, which has started 15 years back. In that, there is a profit. So the question is, can I set off the loss of 3-star hotel with a 4-star hotel profit? The answer is yes. Because a 3580 business loss can set off only against 3580 income. 3580 income means it should be set off only against the eligible business. 4-star hotel is also eligible business. Don't raise a question that it was open 15 years back. Even if it is open 50 years back, 100 years back, then also you can set off the loss of the 3-star hotel against that 100 years old hotel also. Therefore, you can set off the loss. One more item is given over here, that all the expenses were paid by account pay check. Yes, it is necessary to pay the expense by account pay check, account pay draft, ECF, and such other electronic mode. Otherwise 3580 deduction is not allowed. After doing all these things, you will get your total income. Okay. After that, you compute the tax. 30% tax surcharge if applicable. If the income crosses 1 crore, apply surcharge also, and 4% cess. Now, the question is not completed. They have asked tax payable. Now, you also have to compute AMT. Oh, don't forget this. In case a partnership firm other than company, if other than company assessee claims any profit link deduction or 10AA or 3580 except ATP, you have to compute AMT also. How will we compute AMT? Nothing. Total income as per the normal provision and add back all the 3580 deductions. Add back this 7 lakhs, add back this 50 lakhs, add back this 3.2 lakhs. And then claim depreciation on this 7 lakhs, claim depreciation on this 50 lakhs, and claim depreciation on this 3.2 lakhs. This 7 lakh is what? Is a motor car. Therefore, claim 15% depreciation on this. This 50 lakh is a building. Claim 10% depreciation on this. This 3.2 lakhs is a new air condition. Claim 15% depreciation on it. After that, whatever amount will come, that will be adjusted total income. On that, apply 18.5% AMT. Then surcharge if applicable if the adjusted total income crosses 1 crore rupees. Then 4% cess. Then compare whichever is higher and then find out if the AMT is more, you will get AMT credit also. I hope it is clear to all of you. So this is what this question is all about. Beautiful question it is. Coming to question number 2. Question number 2. What is question number 2, sir? Question number 2 is a classic total income question. Whenever a total income question will come in the exam, always remember you have to check the last line first. What is the last line over here? Check the last line. They have asked to compute total income. They have asked to compute tax liability, and also check as per which regime they are asking. They are asking as per new regime 115BAA. Accordingly, answer the question. First, always read the last line, that which regime they are asking. Sometimes they put the regime in the additional information also, so be careful with that. Okay. In the additional information also, you should check which regime is asked. So let us start with the new regime 115BAA. Assassi is an Indian company engaged in manufacturing of automobiles. 9 crore 50 lakh is the profit. The very first adjustment is depreciation as per accounts, therefore add back. Okay. Second adjustment, donation to political party paid by account paycheck, not allowed in 115BAA. ATG, ATGGA, GGB, GGC, all these things are not allowed under what? Under the new regime 115BAA. Next one, you are paying 50 lakh rupees to a scientific research association. So generally, scientific research association is allowed as deduction under section 35, but in new regime 115BAA, that is also not allowed. New regime, donation to scientific research association, statistical research association, social science association, not allowed as deduction. Next one, you are receiving dividend from foreign company of 15 lakh rupees. So what should I do? Reduce from here and show under IFOs. Do not gross up. Even the word received is written. Whenever the dividend is received from foreign company, ICI never grosses up. ICI never grosses up dividend received from foreign company, always remember. What about dividend received from domestic company? That we will see later whenever such adjustment will come. Next one, long-term capital gains of 4 lakh on which equity share, on which STT is paid. It means it is a 112A capital gains. Because STT is paid, therefore it is a 112A capital gains. Therefore, reduce from here and show under capital gains 12.5% tax in excess of 1,25,000 rupees. Therefore, reduce 4 lakh from here and show 4 lakh in capital gains. And while computing the tax, 12.5% tax on 2,75,000, 1,25,000 exemption. Next is a very intelligent adjustment. You have taken a loan of 4 crore 20 lakh rupees from State Bank of India at the rate of 10%, but on 1st of June 2025. Now, this loan is taken for the purpose of purchasing some machinery. Okay. And the interest on the loan is outstanding on 31st March, which was paid on 1st of December 2026. Now, very important. First of all, you have taken a loan of 4 crore 20 lakhs. The rate of interest is 10% and the interest is payable for 10 months because the loan is taken on 1st of June. Therefore, the 10-month interest comes to 35 lakhs. First of all, do that. What do you do? You disallow this 35 lakhs completely because this interest is not an expense. It is taken for the purpose of asset. It is taken for the purpose of plant and machinery. So, whatever is the interest of 10 months, that is 35 lakhs, you add back that interest. 35 lakhs, you add back. Once you add back that 35 lakhs, now you check the treatment. When is the machinery purchased and when is the machinery put to use? The machinery is purchased and put to use on 1st of January 2026. It means from June to December, that is 7 months, the interest should be capitalized. Now find out the interest of 7 months. 35 into 7 divided by 10, that comes to 24.5. Add this to plant and machinery. Sir, this will be added to plant and machinery and claim depreciation? Yes. But sir, it is not paid, doesn't matter. For claiming depreciation, it is not necessary to pay. Only to claim it as a revenue expense, it is necessary to pay. Sir, balance will not be allowed as a revenue expense because it is not paid. It is paid after the due date of filing of return. Always remember, for capitalizing the interest and claiming depreciation, it is not necessary to pay. Only to claim that as a revenue expense, it is necessary to pay. I hope it is clear to all of you. Therefore, ultimately, what is the treatment? Again, I am saying this 35 lakhs will be added back, and then this 35 lakhs into 7 divided by 10, that will be added to the plant and machinery, and the remaining portion will be remaining disallowed forever. Okay, forever means whenever you will pay in the next year you can claim the deduction. Next one, there is a profit on sale of land of 8 lakh rupees to PQR Limited. Who is a PQR Limited? This is a transfer of land between 100% holding subsidiary. If a 100% holding subsidiary transfers any capital asset within themselves, then it is exempt, provided the recipient should be Indian company. If the recipient is an Indian company, it is exempt. In this case, it is exactly happening like that only. So reduce 8 lakh from PGBP and show under capital gains, write a note that it is exempt. Okay. Next one. You have paid a salary of 1 crore rupees to foreign technician for installation of machinery. So this is related to machinery. You cannot debit to P&L. Therefore, add back to PGBP and capitalize to plant and machinery. Next one. You have sold some goods of 22 lakh rupees to a customer. So I am crediting 22 lakh rupees to P&L account. Then out of that, 12 lakh rupees has become bad debts. So I am writing off bad debts of 12 lakh rupees. Now how much is receivable from the debtor? 10 lakh rupees is receivable. Now the debtor has expired. Debtor died. Debtor is dead. After that, we tried to recover and we recover, unfortunately 11 lakh rupees. We were supposed to recover only 10 lakh, but we have recovered fortunately 11 lakh rupees. And unfortunately, we credited entire 11 lakh rupees to P&L account, which is wrong. You should have credited only the excess 1 lakh rupees to P&L account because 10 lakh is already credited to P&L account when we sold the goods. Therefore, you cannot credit entire 11 lakh rupees once again to the P&L account. Whatever is excess recovered, how much is receivable? 10 lakh. You have recovered how much? 11 lakh. Therefore, excess 1 lakh should be credited to P&L because unfortunately, you have credited entire 11 lakh to P&L. Therefore, reduce 10 lakhs from P&L. That is the ultimate effect of this particular adjustment. Next one, depreciation as per income tax, 1 crore 50 lakhs reduced. Then some additions have been made to fixed asset. Building, which is purchased on 15th of December. Therefore, half depreciation because it is used for less than 180 days, 5% will be allowed. Computer, purchase and put to use on 11th May, full depreciation 40%. Plant and machinery, what is the total cost of plant and machinery? See, it is installed and put to use on 1st of January 2026. 500 lakhs is the basic cost, plus 100 lakhs is the foreign technician salary, plus 24.5 lakhs is the interest which will be capitalized. Therefore, the total cost of machinery is 624.5. On that, you will claim half depreciation because the machinery is put to use for less than 180 days. Therefore, you will claim 7.5% depreciation, and additional depreciation not allowed because you are following 115 BAA. Additional depreciation will not be allowed to you. Last but not least, you are declaring some dividend to your shareholder on 31st of May 2026, which is 1 month before the due date of filing of return. Therefore, as per ATM, you will be eligible to claim deduction. How much? Dividend received or dividend distributed, whichever is lower. How much is dividend received? You can see about the dividend received is 15 lakhs and dividend distributed is 12 lakhs. Therefore, you will be eligible to claim deduction of 12 lakh rupees here. After that, you compute the tax. How many taxes are there? On 112A income, you will compute 12.5% tax in excess of 12.5 lakhs, and rest of the income you will directly compute 22% flat tax, 10% surcharge always in 115 BAA, and 4% cess always in 115 BAA. This is what this beautiful question is all about. Let's go ahead with the third question. This is also very, very, very beautiful question. Mr. Rajesh is a resident. Mr. Rajesh is a resident and he is holding some units in PQR and Shipra. Now we need to understand who is PQR and who is Shipra. Shipra is a business trust and PQR is AIF. Always remember, in case I have an investment in business trust, the income is taxable in my hand when the business trust will actually distribute the amount. It means in case of business trust, the investor will be liable on receipt basis. But in case of AIF, the investor will be liable on accrual basis. If the investor, if I am investing in AIF, and if the AIF is earning 100 and they are distributing 90, still 100 will be taxable in my hand. Be very careful. Okay. Now, let's talk about Shipra first. First of all, let's try to understand the holding structure. Mr. Rajesh is holding in Shipra also. He is holding in PQR also. He is holding in business trust also. He is holding in AIF also. Now, Mr. Rajesh is holding how much? Only 10% units. Okay. And the entity is distributing how much? 90% of their profits to the investor. Be very careful. And Mr. Rajesh is earning the following income. Let's talk about business trust first. First, Mr. Rajesh is earning, the business trust is earning. First, let's talk about business trust. Then we will talk about AIF. Business trust is earning 2 crore rupees dividend from GPL. Who is GPL now? GPL is a SPV of business trust. Now, if the business trust receive any dividend from SPV, that dividend is always exempt in the hands of business trust. But what is the treatment of dividend in the hands of the investor? In the hands of investor, it depends. If the SPV has opted for 115BAA, then it is taxable. If the SPV has not opted for 115BAA, then it is exempt. In this question, see, check below. It is written that the SPV has not opted for 115BAA. Therefore, this dividend income is exempt in the hands of what? In the hands of Mr. Rajesh. I hope it is clear to all of you. What about interest from SPV? Interest from SPV is exempt in the hands of business trust, but in the hands of investor, it is taxable. Investor will be liable to pay tax on this. On what basis? On receipt basis. In case of business trust, the income is taxable on receipt basis. So out of 3 crore, how much is distributed? 90%. 90% amounts to how much? 2.7 crore. Out of which Mr. Rajesh holds how much? 10%. Therefore, 2.7 crore into 10% comes to how much? 27 lakh. Therefore, 27 lakh interest will be taxable in the hands of Mr. Rajesh. I hope it is clear to all of you. Third, short-term capital gain on sale of development property. On this, the business trust will pay tax. Investor is liable for exemption. Okay. I hope it is clear to all of you. Now come to PQR AIF. In case of AIF, it is taxable in the hands of Mr. Rajesh on accrual basis. Okay. Now, the very first thing that the AIF is earning is business income. Always remember, on business income, always AIF pay tax, not the investor. Therefore, on this 35 lakhs, Mr. Rajesh will not pay tax. Next, long-term capital losses. That can be given to Mr. Rajesh because Mr. Rajesh is older than 12 months. If the unit holder is more than or equal to 12 months old, then the losses can be given to the losses other than PGBP losses can be given to the investor. So this 20 lakhs, 7 lakhs into 10%, that is 2.7 lakhs. Will be attributed to Rajesh, but Rajesh cannot do anything. Rajesh does not have any other capital gains against which he can set off this loss. If Rajesh would have some other capital gains, he would have set off this losses against it. Therefore, Rajesh will carry for this loss and set off this loss against his subsequent year capital gains income. Last but not least, Rajesh is also earning 52 lakh rupees interest income from AIF. That is IFOs. On this, Rajesh will pay tax. On how much amount? Entire 100%. That is 52 lakhs into 10% share. Now not 90%. In case of AIF, accrual basis taxable is there. Taxation is there in the hands of the investor. Therefore, here Rajesh will pay tax on 52 lakhs into 10%. So 5.2 lakhs will be directly taxable in the hands of Mr. Rajesh. Now, you have to compute tax after that. Tax as per which regime? As per the new regime. What is the new regime slab rate now? So only two incomes are taxable in the hands of Mr. Rajesh. One is 27 lakhs from business trust and one is 5.2 lakhs from interest income from AIF. After that, you have to compute tax as per new regime. What is new regime? New regime slab rates are up to 4 lakh no tax, then 4 to 8, 4%, 5%, then 10%, then 20, 15%, then 20%, then 25%, then 30%. So after 24 lakh, it is 30%. Okay. Now, one more important catch over here in this question is you have to compute tax payable. Tax payable is asked. Always remember, whenever they are asking tax liability, then compute tax and leave it. But when they are asking tax payable, then you have to compute tax. From that, you have to reduce TDS, TCS and advance tax credit also. In this question, Mr. Rajesh TDS has been deducted. Where? At two places. One, on interest income, TDS is deducted at 10% under 194 LBBA, and another on 5.2 lakhs. TDS is deducted under 194 LBB. In both the cases, TDS is deducted at 10%. So on this 10% TDS of 2,70,000 and on this 10% TDS of 5.52,000 would have been deducted in case of Mr. Rajesh. So both this credit should also be given. These small things matter in the examination. Okay. So you have to take credit of these two items, and after that, whatever amount is come, that will be called as tax payable. I hope it is clear to all of you. Next question, we will go ahead. Question number 4. What is question number 4, sir? Pay attention, please, all of you. Question number 4 is on TDS. See what happens generally. Generally, if you go to a tour operator, overseas tour package and program, and if you book any tour, then up to 10 lakh rupees, they will collect 5% TCS, and about 10 lakh rupees, they will collect 20% TCS. But there is some relaxation for non-resident. If a non-resident is coming to India for a visit, and then a non-resident is booking a tour, overseas tour package and program, for that there is a complete exemption, remember. So that is what is happening in this particular question. Mr. Devansh, an Indian citizen. He is residing in New York. He came to India for a visit. So a non-resident is coming to India for a visit for a few days. When he came to India, he booked a tour of 6 lakh rupees to some Malaysia for 1 week. So he is a non-resident coming to India for a visit. He is booking a tour for Malaysia. In his case, the TCS under 206C1G is completely exempt. Therefore, no TCS in his case. I hope it is clear to all of you. Second case. XYZ is a company which is incorporated in the current year. Whether 194Q will be applicable? Absolutely no. If a company is incorporated in the current year, 194Q is not applicable. Why? Because for 194Q to apply, the last year business turnover has to be more than 50 lakh rupees. More than 10 crore rupees. And the current year purchase should be more than 50 lakh rupees. Now, the current year purchase is more than 50 lakhs, no doubt about it. But the last year business turnover is zero in this case because the company is incorporated in the current year. The buyer is incorporated in the current year. Therefore, last year business turnover is zero. Therefore, TDS under 194Q is not applicable in this case. I hope it is clear to all of you. All those things are irrelevant. The very first basic thing is to check the last year turnover. The last year turnover has to be more than 10 crore rupees first of all. Otherwise, this section is not applicable. 194Q is not applicable. I hope it is clear to all of you. Next one, question number 5. Very good question. Mr. Ravi Prakash is aged 52 years. He gifted 30 lakhs to his wife on her 50th birthday. So husband is giving 30 lakh rupees to wife on birthday. What does wife does with that money? Wife purchases a car of 29 lakh 52,000, which includes RTO of 2 lakh 15,000, insurance of 51,000, warranty of 25,000 and accessory charges of 35,000. Now obviously, wife does not have any other great income. She only has 25,000 rupees rental income. 25,000 rental income is how much? It is around 3 lakh rupees income. On that 30% deduction will be available of standard deduction. Therefore, the net income will be 2,10,000, which is lower than basic exemption limit. The question is wife liable to file the return? The answer is yes. Why, sir? Because wife's TCS is collected by the car dealer. How, sir? Wife has purchased a car of 29 lakh 52,000. So 2061F will be applicable if you purchase a motor car of more than 10 lakh rupees of X showroom price. X showroom price will not include all these expenses. X showroom price will not include RTO, insurance, accessory and warranty. Therefore, after reducing all these things, X showroom price is coming to 26 lakh 24,710. Therefore, on that, the dealer would have collected 1% TCS, which is around to 26,247. Now, wife is not a senior citizen. It is less than 60 years and it is resident. Therefore, remember, in section 139, subsection 1, it is written, if your TDS or TCS is greater than or equal to 25,000 rupees of a previous year, then you are liable to file the return. And for resident senior citizen, it is 50,000. So for resident senior citizen, TDS, TCS amount collected and deducted at 50,000 is more, then liable for filing return. For others, if it is 25,000 rupees or more, they are liable to deduct TDS. So in this question, the TCS of Miss Sudha is more than 25,000, more than equal to 25,000 rupees. Therefore, Ms. Sudha is liable for what? Filing the income tax return. I hope it is clear to all of you. Next question, Mr. Vijay. Total income is 28 lakhs. AO has passed an assessment order enhancing the income by 5 lakh rupees. Now he wants to file an application to dispute resolution committee for reducing the penalty or waiving the penalty or reducing the prosecution for immunity of penalty and prosecution. There is no order of detention against him. There is no prosecution against him. There is a penalty under 271D which is initiated against him. So he has a lot of question now. Can he file an application to DRC? The answer is yes. What is the condition to filing application to DRC? Your total income as per your return of income should not exceed 50 lakh rupees, which is not exceeding 50 lakh. And the AO should not increase more than 10 lakh. The AO is not increasing more than 10 lakh. There should not be an order of detention against you. There is no order of detention against me. There should not be any prosecution against you. There is no prosecution against me. There can be a penalty against you. Penalty is there or not, it doesn't matter. All other conditions are fulfilled, therefore he can file an application. Second question, what is the time limit? The time limit is 1 month from the date of receipt of order. The order is received on 26th of November 2026. So 1 month from 26th November 2026 comes to 25th December 2026. This is the last date for giving the application to DRC. Third, if I am not happy with this application, if I am agreed with this application, can I file an appeal? No. No appeal is possible against the order of DRC. No appeal or revision is possible against the order of DRC. Order of DRC is non-appealable. And last but not least, would your answer be different if the AO's assessment order is based on the information received under a DTAA with country X? Yes, answer will differ. It is written in the provisions of 245 MA that if the information is received from foreign authority under DTAA, then the doors of DRC are closed. You cannot come to DRC in that case. I hope it is clear to all of you. Next question is a simple DTAA question. Compute total income, net tax payable, follow the old regime. Mrs. Rajni, 63 years, therefore she is a what? She is a resident as well as she is what? She is a senior citizen. Be careful. She earns income from multiple places. First, she is earning income from country M, 10,120, so multiply that by 69 rupees. Then she has some house property rental income, $25,000. Minus $200 is a municipal tax, so minus that and then claim 30% standard deduction. Then 15 lakh rupees from performance in India, take that as PGBP income, 4.2 lakhs from bank FD and 15,000 rupees from saving bank. So from this bank FD and saving bank, she will claim deduction under 80 TTB because she is resident senior citizen. Then she has paid 29,000 for insurance of her health and 32,000 for insurance of her husband health. Husband is also resident. So both of them, herself and husband, will get aggregate limit of 50,000 rupees deduction under 80D. Then she has invested some 1.5 lakhs in PPF. She can claim ATC for 1.5 lakhs. Then she has invested 4 lakh rupees in 5-year fixed deposit in the name of her son, not allowed. In the name of her son, not allowed. In the name of self, it is allowed. 5-year fixed deposit in the name of self allowed under ATC. In the name of son, not allowed. Anyways, ATC limit is already exhausted by what? PPF, so it doesn't make sense. Even if it is allowed, you cannot claim because already 1.5 lakhs is exhausted in PPF. After that, it's very simple. Compute tax as per old regime. Find out the average rate in India and then apply that average rate, compare that average rate with 20% foreign rate and apply that on doubly tax income. Very simple. The doubly tax income will be what? The doubly tax income will be 11,97,000 is doubly tax, 6,98,000 is doubly tax. These two incomes are doubly tax. Apply the Indian average rate. What is Indian average rate? Indian average rate is this and foreign average rate is 20%. Apply that on doubly tax income. Whichever is lower will be allowed as relief. I hope it is clear to all of you. I hope it is clear to all of you. Question number 8 is a very good question, theory question. What is happening in this question? Pay attention, please, all of you. There are two countries, one country X and one country Y. With country X, we are entering into DTAA. At that time, we are discussing that whatever country X companies will invest in India, we will charge them 15% dividend on dividend tax. So, for example, if country X company invests in Indian companies, we will charge 15% dividend in their hand. And there is a DTAA between both of us. Then we entered into DTAA with country X and country X is an OECD member. Then we entered into DTAA with country Y. There we made a promise that we will charge 10% tax. Country Y is also OECD member. Now country X people are very angry. Why? They are saying that you have entered with us DTAA first, but you are charging more what? You are charging more tax to our people. And you are entering into DTAA with country Y people later and you are charging less dividend tax to them. Why are you doing so? And we both are OECD member. So the CBDT said that don't worry, we will extend this 10% benefit to you also, provided you are OECD member. If you are OECD member, then we will extend. If you are not an OECD member, then we will not extend. So those CBDT has put some condition. The second treaty is entered into after the entry into force of the first treaty. Yes, the second treaty is entered into after first treaty. The second treaty is entered between India and a state which is an OECD member. Yes, the second treaty is also an OECD member. The first treaty is also an OECD member. India limits its rights of taxation in second treaty in relation to the rate. Yes, India will not completely exempt. India will limit its rights to 10%. And the central government will issue a separate notification for the same. Yes, central government has issued a notification for the same in 2022. Therefore, the entity is eligible for 10% tax rate. I hope it is clear to all of you. So this is what this first RTP is all about. I will take a break for 2 minutes. Please let me know how was it, all of you. You have to comment, please. Don't be silent. Please say something. So let's go ahead with the next RTP. RTP May 2023. Question number 1 is a very simple question. There is a partnership firm in which there are 5 partners. Now, one of the partner has given a loan of 50 lakh rupees to the firm. Now, if I am a firm, you are a partner. Just take an example. I am a firm, you are a partner. You are Mr. Raghav, you are a partner. I am a firm, you are giving me a loan of 50 lakh rupees. Now, the firm is questioned by the assessing officer. The assessing officer is questioning firm that from where you have got this particular 50 lakh rupees. So, I said that I received from the partner. So now the assessing officer is asking the partner from where you have got the money. The partner is not able to explain the source. So now if the partner is not able to explain the source, can that 50 lakh rupees be chargeable as deemed income in the hands of the firm? The answer is yes. You remember it is written in section 68 that if you take a loan from someone and if you are not able to explain the source in the hands of the person who is giving that loan, then that also is deemed income in the hands of the receiver. And it will be deemed income under section 68 unexplained cash credit, and that will be subject to 78% tax. I hope it is clear to all of you. So the person who is giving the loan, you have to explain the source in the hands of the giver also. Okay. So this is what this question is all about. Second one, you have taken some loan from a public financial institution on which there is an outstanding interest of 3.5 crore. Now you are converting that outstanding interest into a debenture. Can that be allowed as a reduction? The answer is no. If you convert an outstanding interest into a new loan or into a debenture or into a bond where the liability to pay is deferred to future date, it is not allowed as a deduction under 43B. Yes, but there is a recent judgment which I have told you in the class also. If you convert an outstanding interest into an equity share, that is allowed as a deduction. Please keep this thing in your mind. Okay. So if you convert an outstanding interest into a loan, debenture or bond, it is not allowed as a deduction. But if you convert that into an equity share, it will be allowed as a deduction. So this is what this small question is all about. Question number 3 is also very simple. There are 4 to 5 cases in which you are supposed to answer whether they are liable to file the income tax return or not, considering the situation. First assessee, Mr. Albert, whose turnover of business is more than 70 lakhs. Yes. Any person whose business turnover is more than 60 lakh rupees, you are liable to file the return. Therefore, Mr. Albert is liable to file the return. Second, Mr. Ashish is earning lot of income. First, he is earning 2.5 lakhs from profession. Then he is earning 4 lakh from interest on fixed deposit. Then he is earning another 50,000 from saving bank. Therefore, definitely his total income exceeds basic exemption limit. Therefore, Ashish is liable to file the income tax return. Third, ABC company, a law firm. I will not read ahead. A firm and company is always liable to file the income tax return, irrespective of any condition. If you are a partnership firm, LLP or a company, you are always liable to file the return. Don't read ahead. Similarly, next one, XYZ Private Limited, which has incurred an expenditure of 95,000 rupees towards electricity. It doesn't matter. A company is always liable to file the income tax return. That electricity condition is not applicable for company and firm. That is applicable for individual HUF, that electricity charges exceeds 1 lakh rupees. That is for other than company and firm. Company and firm are always liable to file the income tax return. Last but not least, Mr. Valish. Mr. Valish is depositing 50 lakh rupees in his saving bank. Is he liable to file the income tax return? Yes. If an individual HUF, etc., other than company and firm, deposit 50 lakh or more in a saving bank account, they are liable to file the income tax return. Exact 50 lakh is also covered for saving bank. For business, it is more than 60 lakhs. But for investing, for depositing in saving bank, it is 50 lakh or more. Go and check the provision carefully. Very dangerous. Let's come to question number 4 now. This is a very dangerous question. Very, very beautiful question it is. There are multiple parts in this question. There are many small items in this question. I am trying to say all of them one by one. First of all, let me read the question. There is a cooperative society who is engaged in marketing of agricultural produce grown by its members. So if your cooperative society is engaged in this, they are eligible for ATP deduction. 100% profits are deductible. How much profit they are earning? They are earning 60 lakh profit. Apart from that, they have hired 10 employees. 10 new employees have been hired at a salary of 20,000 rupees on 1st May. Then the company, the cooperative society is getting audited under 44AB. The salary is paid by account paycheck. All these conditions are necessary. Then it also earns interest on FD of 32 lakh rupees. Now, these are the basic information which is given. Now, you are supposed to compute total income and tax liability. Don't read ahead. Now, when you are computing total income, you are supposed to compute total income as per 2 points now. First, as per the normal provision, then compute tax as per normal provision, and then compute AMT. AMT also. And always remember, in case of AMT for cooperative society, the tax rate is not 18.5%, it is 15%. So let's compute the total income as per normal provision. What will come in normal provision? First, 60 lakhs will come. PGBP, then 32 lakhs IFOS will come, interest on fixed deposit, then 60 lakhs will be allowed as deduction fully under ATP, then 80 JJAA will also be allowed. Why? Because you are hiring 10 employees, 20,000 emoluments, less than 25,000 rupees for 11 months. So 20,000 into 10 employees into 11 months into 30%, 80 JJAA you will claim. So you will claim two deductions. One ATP, directly ATP of that marketing from agricultural produce grown by its members. That entire amount will be deductible under ATP, and 6,60,000 will be allowed under ATJJAA. Then you will compute the tax. Normal tax for cooperative society. What is the normal tax for cooperative society? Up to 10,000, 10%. About 10,000 up to 20,000, 20%. About 20,000, 30%. Then surcharge if applicable. In this case, surcharge is not applicable because the income is less than 1 crore. This is your normal tax. Now you will compute your AMT. While computing the AMT, always remember how AMT is computed. It is nothing but total income plus profit link deduction except ATP. While computing AMT, don't add ATP. AMT is not applicable on ATP incomes. ATP deductions are not subject to AMT. Be very careful. You will not add back this 60 lakh rupees while computing AMT. Yes, you will add back this 6,60,000 while computing AMT. So while computing AMT, add back 6,60,000. Don't add 60 lakhs. You will get your adjusted total income. On that, apply 15% tax, 4% cess, and no surcharge because the adjusted total income is less than what? Is less than 1 crore. This is your first part. Second part. Then check whichever is higher. Whichever is higher, that will be your tax. Now, the second part of the question, advise whether it should opt for 115 BAD. Now, what will happen if they opt for 115 BAD? Let's try to understand. If they opt for 115 BAD, the very first thing which will be removed is AMT. AMT not applicable for 115 BAD SSE. So, 115 BAD SSE will compute how? First, you will write 60 lakhs. Now, I am making the changes in this solution only. First, I will write 60 lakhs. Then, I will write 32 lakhs. 92 lakhs is your gross total income. For 115 BAD SSE, this is allowed, but this is not allowed. For 115 BAD SSE, ATP is not allowed. Only ATJJAA is allowed. So 115 BAD SSE, very straightforward. This is there. ATJJAA is allowed in 115. BAD ATP is not allowed in 115 BAD. Whatever is your total income, on that you will directly apply 22% tax because in 115 BAD the tax rate is directly 25.17. 22% tax, 10% surcharge, 4% cess, and that will come to 21,49,350 rupees. Now there is another part in this question, dangerous part. Would your answer be different if it is not a cooperative society but a cooperative bank? Yes, the answer will completely change. If it is not a cooperative society but a cooperative bank, how the answer will change? Now we will assume this to be cooperative bank. This will be 60 lakhs income, this will be 32 lakhs income. Gross total income 92 lakhs. Now for cooperative bank, this will be allowed, this will not be allowed. Cooperative bank will not be allowed this. So for cooperative bank, what is the deduction? The deduction only ATJJAA will be allowed. ATP will not be allowed to cooperative bank. So therefore 85,40,000 will be the total income of cooperative bank as per normal provision. All three calculations you have to do once again. Then apply up to 10,000 10%, about 10,000 20%, about 20,000 30%. Then apply cess, etc. Surcharge not applicable. Now again AMT. While computing the AMT, again you will add back ATJJAA. ATP is not there only. So what you will add? ATP is not there. So you will add back ATJJAA and compute AMT. So add ATJJAA, compute AMT of 15% AMT, 4% cess. Then again 115 BAD. While computing 115 BAD, how the things will go? Assuming it is a cooperative bank, 60 lakhs will come, 32 lakhs will come. Then this is allowed in ATJJAA. So in ATJJAA, this is allowed. Therefore, the income will remain same in ATJJAA. So 85,40,000 will be the income in in 115 BAD also. Same income because ATP is not there only. Now you will compute 22% tax, 10% surcharge, 4% cess, and compare the answer whichever is more beneficial. Okay. So this is what this beautiful question of what? Beautiful question of cooperative society is there. I have given you a chart of cooperative society in the class. Go and check. Okay. Next question is a total income question. Again, whenever a total income question comes, you have to check what? You have to check the last line first. What is asked? They have asked to compute total income. They have asked to compute tax liability as per 115 BAA. Okay, 115 BAA is coming again and again. Be very careful with that. 115 BAB is not very important. BAA is very important for us in the examination. SF Limited is a company engaged in manufacturing and sale of pharmaceutical products. So very first thing is they are engaged in pharma company. Their profit is 930 lakhs after debiting and crediting the following items. Now the very first item over here is the opening stock is overvalued. The opening stock is overvalued by 10%. Now the opening stock is 66 lakhs. It is overvalued. It means it is standing at 110%. Therefore, how much it is overvalued? So 10% is how much? 6 lakh. It is overvalued. So if the opening stock is overvalued, means the debit side of the P&L is overvalued. If the debit side of the P&L is overvalued, it means you have claimed more expense, so add back. You have claimed more expense, na? So add back this 6 lakhs. This 6 lakhs will be added back. Similarly, the closing stock is undervalued. Now your closing stock is 63 lakhs. It is undervalued by 10%. It means it is standing at 90%. Therefore, 10% is how much? Cross multiply, it comes to 7 lakhs. So if the credit side of the P&L is undervalued, it means the profit is less. So add back the 7 lakhs. So the opening stock will also be added back. The closing stock will also be added back. I hope it is clear to all of you. Next one, you are purchasing some know-how from foreign company. Now, know-how is nothing but an intangible asset, but you are debiting that to P&L, which is wrong. Add that to P&L and claim what 12.5% depreciation, because you are putting to use for less than 180 days. Therefore, you will not get full 25% depreciation. You can claim depreciation of 12.5%. Next one is a grandfathering clause. Grandfathering clause, you are selling some shares of a listed company, 2,97,000 is the profit. First, reduce this 2,97,000 from PGBP, and then under capital gains compute separately. But always remember, whenever 31st Jan 2018 will come in the examination, it means there is a grandfathering clause. Whenever this date only has one relevance, that is grandfathering clause for the purpose of capital gains under 112A. So how will you compute the capital gains? First step, actual cost. Actual cost means the price at which you have acquired the shares, 85 rupees. Then compare with lower of FMV on 31st January 2018, that is 195, and selling price. Lower of the two is 195. Then lower of the two will be compared with actual price. Then whichever is higher, that will become your ultimate cost. Therefore, in this case, your ultimate cost will be 195 and your sale price will be 220. The difference between them will be called as capital gains. On that will show you that you will show under capital gains, under the head capital gains. On that, 1,25,000 rupees flat exemption will be available. On the remaining amount, 12.5% tax will be available. Okay. Electricity charges of 8 lakh is unpaid. So what? Electricity charges are allowed on payment basis? No, no, no. Electricity charges are not covered in 43B. Electricity charges are on accrual basis. Therefore, this will be allowed. Even if it is unpaid, it will be allowed as a deduction. Don't worry about it. Okay. Next one. You are incurring some loss of 2.2 lakh rupees due to hedging contract in respect of import of raw material. So, you are importing some raw material. On that, you are incurring some loss. How much loss you are incurring? You are incurring loss of 2.2 lakh rupees on foreign currency fluctuation due to hedging contract. So that loss is nothing but a revenue loss, because that loss is on raw material. Therefore, that will be allowed as a deduction. It is allowed as a business loss. Next, depreciation as per books of accounts, add back. Next, dividend from foreign company. Dividend from foreign company, I have already told you, reduce from here and show under what? Income from other source. Show under income from other source. Next, 32 lakh rupees you have received from some company for entering into a non-compete contract. So whatever amount you receive in cash or in kind under an agreement for not carrying out any activity in relation to business and profession, that is for non-compete contract, that is considered to be a PGBP income. So let it be part of PGBP. There is nothing wrong in that. Next, you are receiving some advance of 22 lakh rupees. For what? You are about to sell some land, but the negotiation did not go, so you forfeited that 22 lakh rupees. So what is the treatment of this 22 lakh rupees? First of all, reduce from here and show under IFRS. Why? Because the forfeiture is happening after 1st April 2014. If the forfeiture is happening before 1st April 2014, then you will reduce from the cost of acquisition whenever you will sell it. But if the forfeiture is happening on or after 1st April 2014, then it is treated as an income from other source. Directly treated as income from other source. Next, you are having some profit on sale of unlisted shares of 18 lakh rupees. First of all, reduce from here and show under capital gains. How capital gains, sir? Because you have purchased for 80 lakhs and you are having an excess of 18 lakh rupees. So under 18 lakh rupees will be shown as a long-term capital gains, because you purchased in 2018 and sold in 2026. Therefore, it is sold after 24 months. Therefore, it is long-term capital gains. On that, you will apply what? You will apply 12.5% tax. Next, loss of 2 lakh rupees is there on hedging contract for foreign currency payment on imported machinery from Japan. So you are importing some machinery from Japan on which you have done some hedging contract, on which there is a loss on payment. So section 43A will apply. Whatever the loss is there, first of all, add back that loss to PGBP. That is not allowed. Then add that loss to what? Add that loss to machinery. Therefore, the machinery cost will become 72 lakhs. On that, claim normal depreciation of 7.5%, because the asset is used for less than 180 days. Additional depreciation not allowed, because the asset is following 115BAA. I hope it is clear to all of you. Next, normal depreciation 35 lakhs you will claim. Then they have said that imported machinery and know-how depreciation has not been considered. Therefore, we are computing the imported machinery depreciation and know-how depreciation separately. Okay. Now, last but not least, you are hiring some 59 additional employees. 80 JJAA question. All of them are contributing in recognized provident fund. Great. It is necessary to contribute in recognized provident fund to claim 80 JJAA. But out of that, only 36 employees joined on 1st of June. On an emolument of 15,000. From that 36 employees also, it is written 10 employees salary settled by bearer check. So those will not be eligible for deduction under 80 JJAA. If you pay by bearer check, if you pay by other than 4 modes, you are not eligible for 80 JJAA. So therefore, only 26 employees will be eligible for 80 JJAA. 26 employees into how many months? 1st June, 10 months into 15,000. Emolument is less than 25,000 into 30%. But be careful with one more thing. The 10 employees whose salary is settled by bearer check, their salary should be disallowed in PGBP also as per 48.3. So disallow their salary in PGBP. because in PGBP also that expense will not be allowed. I hope it is clear to all of you. Then another 18 employees joined on 1st July, but their salary is 35,200, therefore they are not eligible for 80JJAA. Then another 5 employees joined on 1st November, their salary is 22,000, but they are not eligible for 80JJAA because they are employed for less than 240 days. In 80JJAA, the employees have to be employed for at least 240 days. After that, you are supposed to compute tax. Now, there are three taxes over here. 1112A on that 12.5% in excess of 1.25 lakhs. 1112 12.5% tax directly. And rest of the general income will be subject to 22% tax, 10% surcharge always, and 4% cess. I hope it is clear to all of you. So, this is what this beautiful question is all about. Next question is also a very good question, which is on non-resident taxation. So there is a foreign company over here by the name called as Gamma Inc. That foreign company is providing some technical services, fees for technical services to an Indian company, and there is an agreement between both of them which is approved by central government. So this is a classic case of 115A because there is no permanent establishment also in India. So if a foreign company providing what technical services to an Indian concern, there is an agreement between both of them. Agreement is approved. The services provided are FTS and there is no P. 115A is applicable. Flat 20% tax. 2% surcharge because the income is more than 1 crore and 4% cess. Expenses will not be allowed of 22 lakh rupees under 115A, and while filing the return, they need to be careful. If they earn only this income, and their TDS is deducted as per 115A rate, not lower than 115A rate, not as per the DTAA lower rates. If the TDS is deducted as per 115A, then they are not liable to file the income tax return. I hope it is clear to all of you. Part 2. Will your answer change if that foreign company has a permanent establishment in India? Yes, the answer will drastically change. If that company has a permanent establishment in India, then 44DA will apply. In 44DA, you will take income, you will reduce expenses. 3 crore minus 22 lakhs. Again, you will take 5 crore minus 35 lakhs. But any expense which is not wholly and exclusively for Indian branch will not be allowed. Therefore, this point number 5 will not be allowed. Because this is not only and exclusively for Indian branch, therefore that will not be allowed to as a reduction. Similarly, if Indian branch is making some payment to HO other than reimbursement, then it is not allowed. If it is giving reimbursement, then it is allowed. Other than reimbursement, not allowed. Other than reimbursement, not allowed. What are the other requirements? Other requirements are this assessee has to maintain books of account, they have to conduct audit, they have to file ITR, they have to pay tax as per the normal rate. 35% tax, 2% surcharge because the income is more than 1 crore or 4% cess. I hope it is clear to all of you. This question number 7. This question number 7 is a very famous question. A lot of time they have asked this question. Question number 8 is on transfer pricing. PN company is a company which is in India and Zeta Inc. is in foreign country. Now, one entity guarantees 12% of the total loans of another entity. Therefore, both of them are deemed to be associate enterprise. Why? Because as per 92A, if one enterprise guarantees at least 10% of the total loans of the other entity, then both of them are deemed to be associated. Here it is 12%. Therefore, both of them are deemed to be associated. Therefore, the transaction between both of them are international transaction. And therefore, transfer pricing is applicable. Point number 2, without prejudice to point number 1. Assume that whether point number 1 happens or not, ignore that. And then answer, if AO makes a primary adjustment of 3.1 crore rupees on 1st April and the same is accepted by the assessee, what are the conditions and the money is not repatriated to India up to 31st March and the transaction is denominated in INR. So, if the AO makes the primary adjustment of more than 1 crore rupees, then secondary adjustment is applicable if the money is not repatriated to India within 90 days from the date of order. So the AO has passed the order on 1st April 2025 and if the money is not repatriated to India within 90 days from 1st April 2025, then the AO will charge secondary adjustment because the primary adjustment is more than 1 crore rupees, it is 3.1 crore. So how the primary adjustment will be charged? 3.1 crore will be considered as deemed loan multiplied by SBI's MCLR on 1st April 2025 plus 3.25%. So 12.25% will be the rate of interest. Multiplied by 365 divided by 365 because the loan is denominated in INR, therefore you will take SBI MCLR. If the loan is denominated in foreign currency, then we will take LIBOR plus 3%, 6 months LIBOR plus 3%. One more option is there. You pay one time additional tax on 3.1 crore. How much one time additional tax on 3.1 crore? Then secondary adjustment will stop. How much is that one time additional tax? 18% tax, 12% surcharge, 4% cess, pay that much tax and you will be relieved from what? You will be relieved from what? You will be relieved from this particular secondary adjustment after that. I hope it is clear to all of you. So this is what this paper is all about. Now comment below. Take a break for 1 or 2 minutes. Say something in the bit below. How is it going, guys? So let's go ahead with the next RTP, that is RTP November 2023. Very first question again over here is on total income only. Associates engaged in manufacturing. Let's read the last line first of all. You are supposed to compute total income and tax liability of Mr. Manav and Manav Limited has opted for 115 BAA. So accordingly you need to answer. The profit of the Manav Limited is 180 lakhs. Again, here there is some outstanding interest of 24 lakhs. Now they are trying to discharge that outstanding interest by issuing 8% debenture, not allowed. Conversion of outstanding interest into a new loan or into a debenture or into a bond is not allowed. But if you convert that into equity share, it is allowed as a reduction, which I have told you earlier. Then there is some income tax demand of 5,80,000 that will be disallowed. Even surcharge is disallowed. Even cess is disallowed under section 40A1. Okay, 48(2), sorry, not 48(1)(a). 48(2), income tax including surcharge and cess is disallowed. Then there is some provision of gratuity as per actually that is disallowed under 40A7, and whatever gratuity is actually paid, which is given in the last point, that is 105 lakhs, that will be allowed as a deduction, which you can reduce from your PGBP income. Next one is very important and controversial adjustment. Lot of students have lot of doubts in that. You are incurring some expense on foreign travel of directors. They are going to open some branch in foreign country to market their product. Always remember, it will be allowed as deduction. Why? Because if you are incurring some expense on travel of directors, foreign travel of directors, and if that expense is related to existing business, then it is allowed as deduction. But if that expense is related to new business, then it will not be allowed as deduction. In this case, it is related to existing business, therefore it is allowed as deduction. I hope it is clear to all of you. Then you are purchasing some raw material of 82,000 rupees. And you are making the payment in cash, not allowed. More than 10,000 rupees in cash, not allowed. Therefore, this 82,000 will be disallowed under 40A3. Next one, you are making a payment of 11 lakh rupees to a Japanese company whose income is chargeable to tax in India. So, if a non-resident or foreign company's income is chargeable to tax in India, you need to deduct TDS. Now, you have not deducted the TDS, therefore, 100% expenditure will be disallowed in that case. Next, you are incurring some 4.6 lakh rupees on corporate social responsibility expense. Corporate social responsibility expenses are not allowed as per explanation 2 to 37(1). It is not allowed. Next one is a routine adjustment. 100% holding subsidiary selling something to each other. Capital gains is exempt only if the recipient, that is the receiver, is an Indian company. Therefore, reduce from here PGBP and show as exempt under 47. Always remember, if the recipient is a foreign company, then it is taxable. It is exempt only if the recipient is what? Is an Indian company. Next one, you are giving some donation to what? Donation to a scientific research association, not allowed in 115BAA. Now they are giving us 1.2 lakh is paid in net banking and balance is paid in cash. It doesn't matter. In 115BAA it is not allowed only. So if it is not allowed, then it doesn't matter how it is paid. Okay. Next one, interim dividend is paid of 65 lakh rupees. So interim dividend will be claimed as a deduction under ATM, but the dividend will be subject to what? Dividend received. Dividend received or dividend paid, whichever is lower, will be allowed as deduction under ATM. See, always remember in 115BAA, you cannot claim any chapter 6A except ATM, ATLA and ATJJAA. These three deductions you can claim in what? 115BAA. Next one is you are contributing. The employer is contributing to some pension scheme of employees, which is 15% of the salary and dearness allowance. How much is allowed? Only 14% of basic salary plus DA in terms is allowed. But you are contributing how much? 15%. Therefore, 1% you have to disallow as per section 36 subsection 1 clause 4A. Next, you are receiving some dividend from a foreign company. How much? 36 lakhs. So reduce this from PGBP and show that 36 lakhs in what? In IFOs. And compare that 36 lakhs with dividend received 36 lakhs, dividend paid 65 lakhs. Therefore, whichever is lower will be allowed as deduction under ATM. Next, you are giving some donation to a political party, not allowed under AT, not allowed under 115BAA. Next, normal depreciation allowed, additional depreciation not allowed under 115BAA. Next, brought forward UAD allowed because it is out of normal depreciation. If this brought forward UAD would have been from additional depreciation, even this would have not been allowed. Okay. And last one, I have already told you. There is no special income in this case. Therefore, only 22% tax, 10% surcharge and 4% cess will be imposed. No special income, no long-term capital gains, no short-term capital gains, nothing is there. So this is what this question is all about. Let's go to the next question. Next question is on TDS and TCS. There is a buyer, Delta Limited, which is a buyer, and there is a seller by the name called as Fee Limited. What are we buying? We are incorporated just this year on 1st April 2025 and we are buying coal from them. Always remember, if the seller is selling coal, then generally the seller is liable to collect TCS on coal at the rate of 1%. Coal is covered under 206C subsection 1. So the seller should collect TCS. But there is a relaxation from collecting TCS if the buyer is a resident and the buyer gives a declaration that he will use this coal for manufacturing or power generation and not for trading. In this case, the buyer is giving a declaration that he will use this coal for manufacturing and not for trading. Therefore, the seller will not collect TCS. But in that case, the buyer is liable to deduct TDS under 194Q. But in this case, even the buyer will not be liable to deduct TDS under 194Q because for 194Q, your last year turnover should be more than 10 crore. Business turnover should be more than 10 crore and the buyer is incorporated in the current year. Now, because the buyer is incorporated in the current year, the last year business turnover is 0. Therefore, the buyer is not liable to deduct TDS also in 194Q. So again, I am saying one more part is there in this question. Again, I am saying the seller is not liable to collect TCS on coal because the buyer is giving declaration. The buyer is not liable to deduct TDS because the last year business turnover is 0. Now, the last line of this question they are saying, will your answer change if the buyer is incorporated in last year? The buyer is incorporated not in the current year, but in the last year, and the last year turnover is 10 crore. Still, the answer will not change because the last year, for TDS to apply under 194Q, the last year business turnover should be more than 10 crore. Even if it is exactly 10 crore in the last year, TDS under 194Q will not apply. I hope it is clear to all of you. See how they are exactly asking the questions on margin. Exact 10 crore, if it is last year business turnover, 194Q is not applicable. Even in that case, 194Q is not applicable. Next one, let's go ahead with the next question. Sigma is a manufacturer of car and they are selling some car to car dealers. Always remember, if a manufacturer sell car to car dealer, then provisions of 206C1F is not applicable. Very clearly written in the law that if a manufacturer is selling to dealer, the 206C1F provisions of collection of TCS not applicable. But in that case, the buyer will be liable to deduct TDS under 194Q if the buyer's last year business turnover is more than 10 crore and the buyer purchases car of more than 50 lakh rupees. So in this case, who is the buyer? The buyer is Epsilon and Omega. Now, Epsilon's last year turnover is 14 crore. Therefore, Epsilon will be liable to deduct TDS of what? Epsilon's last year turnover is 14 crore and Epsilon is buying cars of how much? 120 lakhs. Therefore, on 70 lakh rupees, Epsilon will deduct TDS at the rate of 0.1%. But Omega's last year turnover is only 9 crore. Therefore, Omega will not be liable to deduct TDS also. So, in case of Omega, neither TCS nor TDS will apply. But in case of Epsilon, TDS will be applicable on Epsilon. TCS will not be applicable because the cars are sold by manufacturer to dealers. I hope it is clear to all of you. Third question is a very simple question which I have told you in the class of British Airways Supreme Court judgment is there, Royal Dutch Airlines Supreme Court judgment is there, Singapore Airlines Supreme Court judgment which we have done in section 194H. See, the agents, air travel agents gets two type of commission. One is called a standard commission, which is a percentage, which is percentage of the price, which is this. Sorry, percentage. Sorry, just a second. So there are two types of commission which are earned by the air travel agents. One is a standard commission, one is a supplementary commission. Sir, what is a standard commission? Standard commission is a commission which is a percentage of the price which is decided by ITA. International Air Transport Association, they will decide. Some percentage of that will be considered as a commission. Second is the difference between the price which is decided by the airline company and the price at which the tickets are sold. Suppose the airline company said that you should sell at 60,000. Now the air travel agent is selling for 70,000. So the 10,000 is the commission, supplementary commission. So the question over here is whether TDS under 194H will be applicable on both supplementary commission as well as the normal commission. Supplementary commission as well as the standard commission, and the answer is yes. The Supreme Court in the case of Singapore Airlines, KLM Royal Dutch Airlines and British Airways PLC has held that the TDS under 194H will be applicable on standard commission as well as on the supplementary commission. So this is what this case law is all about. Next one, very simple question. Sir, what is there in the next question? For AY 22-23, you are filing your original return on 28th December and for declaring total income of 12 lakhs. And for AY 23-24, you are declaring a loss of 5 lakhs. They are filing the return on 30th October 2023. Now, for this second year, you want to file updated return. You already have a loss. Now you want to file an updated return by declaring income of 7 lakh. Can you file an updated return on 30th November? The answer is yes. If you have a loss of 5 lakh rupees, now you want to convert that loss into income of 7 lakh rupees, updated return can be filed. Now, by when it can be filed? If it is filed within 12 months from the end of relevant year, you have to pay 25% additional tax. After 12 months up to 24 months, 50% additional tax. After 24 months up to 36 months, 60% additional tax, Finance Act 2025 amendment. And after 24 months, after 36 months, but up to 48 months, 70% additional tax, again Finance Act 2025 amendment. Therefore, in this case, because your loss is converting to income, you can file updated return. Secondly, you can file updated return when? Up to 30th November, if you are filing, it means you are filing within 12 months from the end of relevant device. Therefore, you are liable for 25% additional tax. 25% additional tax you have to pay. Now, second question in this, what is the time limit for completing assessment? See, in first case, normal return is filed. In second case, updated return is filed. So, when a normal return is filed, the time limit to complete assessment is 12 months from the end of relevant device. The relevant device 22-23, 12 months from the end of 22-23 is 31st March 2024. But when an updated return is filed, it is not 12 months from the end of relevant device. Then it is 12 months from the end of the financial year in which the updated return is furnished. So the updated return is furnished on 31st of October 2023. 12 months from the end of 23-24. 12 months from the end of 23-24 will come to 31st March 2000. 12 months from the end of 30th November 2024, 12 months from the end of 24-25 will come to 31st March 2026. So in this case, the updated return will be filed till 31st March 2026. I hope it is clear to all of you. Let's go to question number 5 now. There is a search in the premise of Mr. Ajay and 160 lakhs undisclosed income is found in the search. Now, Mr. Ajay wants to set off some losses of earlier years of 90 lakhs and UAD of 30 lakhs against this income of search. Can he set off? The answer is no. Against the income which is found in search and seizure, no losses or UAD can be set off against that income. Therefore, this loss is not allowed to Mr. What? Mr. Ajay. I hope it is clear to all of you. Next question is a very simple question on DTAA. Let's try to understand this. There is an assessee aged 45 years, resident of India. Which regime we are following? We are following old regime. First, he is earning some basic salary of 62,000 rupees per month multiplied by 12. On that, 50,000 standard deduction will be allowed. Then dearness allowance 10%. Then royalty income is there from country M in literary book. For literary book, therefore they are eligible for 80 QQB also. Royalty you can show under PGBP or IFRS. ICI has shown under IFRS. You can show under PGBP also. It's okay. 9,80,000 is the gross royalty. 98,000 is the expense, and 3 lakh rupees will be allowed as deduction under 80 QQB. Be careful. Then you are earning some rental income from country N. Then you can claim 30% standard deduction on that. Then you are earning some dividend of 2,20,000 rupees. You can show that under IFRS. Then you are purchasing some residential house property in Bhopal of 23 lakh rupees. On that 1% stamp duty you have paid. Always remember, whatever stamp duty you pay, 1% will come to 23,000 over here. That can be claimed as deduction under 80C. 80C will allow that as a deduction. I hope it is clear to all of you. Then 26,000 rupees you have paid health premium for yourself, and 50,000 you have paid health premium for your non-resident what? Non-resident father. So therefore 26 6,000 you will get for 25,000 you will get for yourself, because you are not a senior citizen, you are just 45-year-old. Therefore, you will get 25,000 for yourself, and for your father also you will get only 25,000 only, even though your father is senior citizen, but your father is non-resident. Therefore, inflated limit of 50,000 will not be available for non-resident. It is only available for resident senior citizens. Therefore, for yourself you will get 25,000, and for your father also you will get 25,000 rupees. After that, you compute the tax. You compute the tax as per old regime, and then find out the doubly tax income. As simple as that. While computing the doubly tax income, you need to be very careful. For doubly tax income, 1,96,000 is doubly tax income. Then your royalty is 8,82,000 is not doubly tax income. For computing doubly tax income, you have to take 8,82,000 minus 3,80,000 QQB also, and then find out the doubly tax income. That will be your doubly tax income. I hope it is clear to all of you. Question number 7. Very simple question, nothing great, but a good question. There is a foreign company from Germany who has opened a branch in India for sale of LED. Now they are selling some goods from the branch in India, and some goods they are selling directly from outside India. So the officer wants, which has nothing to do with Indian branch. Some goods they are selling from branch in India, some goods they are directly selling from Germany in India, which has nothing to do with Indian branch. The officer wants to charge the goods which are directly sold to India from Germany also. Can he do so? He can do that in UN model, but he cannot do that in OECD model. Why? Because such concepts are called as force of attraction. Do you remember? Rolls-Royce example I have given you in class. If you open a branch of Rolls-Royce in India, and if you sell the Rolls-Royce through India, that is definitely taxable. But in force of attraction, if you directly also sell Rolls-Royce in India, that will also be taxable under UN model. That is called as force of attraction. But unfortunately, force of attraction is only there in UN model. It is not there in OECD model. Therefore, in OECD model, such items will not be charged. In OECD model, only the items which are sold through Indian branch, through Indian PE will be subject to tax, not something which is directly sold. Okay, I hope it is clear to all of you. So this is what this RTP is all about. Please comment below, how is it going? Fast. Let's go ahead with the next RTP, that is RTP May 2024. The very first question again over here is of total income. Associates engaged in manufacturing and selling of pharma products. And here we have to compute lot of things. You are supposed to compute total income and tax liability in the most beneficial manner. Therefore, you have to make three calculations first. First, you have to compute total income and tax as per normal provision. Then you have to compute total income and tax as per 115 JB, that is book profit, etc. Then compare whichever is higher, that will be answer number 1. And then you compute total income as per 115 BAA, because they have asked us to compute as per most beneficial manner. So first, three calculations you have to make: normal provision, MAT, and then 115 BAA. First, I am computing as per normal provision. The very first thing over here is 900 lakh is your net profit. First thing is, now the things will repeat, adjustments will repeat to some extent, okay? As and when you go ahead, the adjustments have to repeat. Obviously, after doing all the 26 papers compilation, 90% of the adjustments will be repeated in the examination. Don't worry about it, okay? Now, in the month of November, you are purchasing some know-how, and this know-how is purchased in November. Therefore, add back this know-how. Know-how will be allowed as a depreciation, and you can claim 50% depreciation, that is 12.5%, because it is put to use in the month of December. It is used for less than 180 days. So you can claim 12.5% as a depreciation. Next, electricity charges are unpaid. Doesn't matter, electricity charges are allowed on accrual basis. Even if it is unpaid, it is allowed as a deduction. No worries. Next, loss of 4 lakh for purchase of raw material on foreign exchange fluctuation price. So you are importing some raw material, you are doing some hedging contract, and on that hedging contract there is some forex loss. So that forex loss is allowed as a deduction. Same adjustment has come earlier also, it is allowed as a business loss. Okay. Next, depreciation as per books of accounts will be added back. Then loss of 2 lakh for purchase of imported machinery. Again there is a forex loss, so now 43A will apply. What will you do? Same adjustment, again repeating. 2 lakh rupees you will add back to PGBP income, and then you will add back this 2 lakh to the cost of asset. You will add back this cost of asset, so therefore the machinery cost will be 65 lakhs plus 2 lakhs, 67 lakhs. On that you will claim 7.5% depreciation, because the machinery is used for less than 180 days, and you will also claim 10% additional depreciation because the associate is engaged in manufacturing. And now we are computing income as per normal provision. In 115 BAA we will add back this additional depreciation. Okay, so when we will compute the 115 BAA total income, at that time we will add back this depreciation. Then 20 lakhs you are receiving as a non-compete fees for entering into a contract, for not entering into a certain business. So that is considered as a PGBP. Let it be part of PGBP. Write a note for the same. Okay. Then you have received some advance and you have forfeited that advance in respect of transfer of a capital asset. If that advance is forfeited on or after 1st April 2014, then it is considered as IFOS. Therefore, reduce from here and show under IFOS. Then there is some profit on sale of unlisted shares, 15 lakh rupees, reduce from here, show under capital gains. Those unlisted shares were acquired in 2022. Now you are self given. Book profit is 1520 lakhs. 1520 lakhs directly book profit they have given. Therefore, book profit is 15 crore 20 lakh. So how much tax you will apply on this book profit? 15 crore 20 lakh rupees into 15% tax plus 12% surcharge, because the book profit is more than 10 crore plus 4% cess. Okay, I hope it is clear to all of you. Then compare normal provision or book profit, whichever is higher, that will be your answer number 1. Then you compute the tax as per 115 BAA. In 115 BAA, only one thing will be added back, and that is the additional depreciation on plant and machinery. That's it. That's the only thing which will be added back in 115 BAA. You can check it over here. Additional depreciation you will add back, that will give you your total income. In this total income, there are two incomes. One is special income. Long-term capital gains will be chargeable at 12.5%. Other income will be chargeable at normal rate of 22% tax, 10% surcharge, 4% cess. And ultimately you check which is beneficial. Is the normal provision beneficial, or is the 115 BAA beneficial? That whichever is the most beneficial, you have to give comment on that particular thing, because that is the question which is asked over here. Next is a theory question, small question. The commissioner has a power to revise the order of AO under 263. Okay, so therefore the commissioner has issued some notice to the assessing officer that I want to revise your order under 143. So step number 1, the commissioner has issued notice under 263 that I will revise your order under 143.3. After that, survey has happened in place of assessees. At assessee's place, survey happened. There some new information came. Now the commissioner is issuing second notice after the survey. The content of the second notice is different from the first notice. So there is a 3-step discussion over here. Step number 1, commissioner is starting revisionary proceeding under 263. After that, survey happened at assessee's place. Now the commissioner is sending a second notice to the AO. The content of the second notice is different from the first notice. Can the commissioner do so? The court has said that no. The commissioner should stick to the decision which he has taken earlier. The commissioner should stick to the points which he has given in notice number 1. Just because the survey has happened later on, now he wants to withdraw the first notice and send a second notice, and based on that he wants to revise the order under 143.3. That cannot be done by the commissioner. Therefore, the commissioner is incorrect over here. I hope it is clear to all of you. Question number 3 is on black money law. Black money law, always remember, for understanding the black money law, the very important term of black money law is assessee. You should be assessee in black money law. There are 2-3 points which you need to keep it in mind to understand black money law. First of all, the definition of assessee. Who is an assessee? Assessee can be now any of the person. A person should be resident in the current year in which you are caught. In our example 25-26, or the person should be resident in the year in which the income was taxed, income was earned, or in which the asset was acquired. You should be resident in either of the 2 years. You should be resident either today when you are caught, or you should be resident in the year in which you have earned the income or in which you have purchased the asset. If you are non-resident in both the years, then you cannot be called an assessee. Then you cannot be subject to black money law. You should be resident either today or in earlier years. Further, one more thing you need to keep it in mind with respect to black money law is that in black money law, 2 things are charged. One is foreign income, one is foreign asset. Foreign income will be charged to the year to which it pertains, but the foreign asset will be charged in the year in which it is found. So if the AO has found foreign income today and foreign asset today, foreign asset will be charged today, but foreign income will be charged in the respective year. So therefore, the black money law came in 2015-16. So if the foreign income is pertaining to earlier than 2015-16, then black money law cannot be charged. But if the foreign asset is pertaining to earlier than 2015-16, still the foreign asset can be charged, because foreign asset is not charged to respective year. Foreign asset is charged in the current year. These are the few basic things that you need to keep it in mind. Now, Mr. Rohit is an Indian citizen. He came to India in March 2014 and then he left India in March 21. Therefore, from 2014-15 to 2020-21, he was resident. Now, in the current year 25-26, he is not resident. But from 14-15 to 2021, he was resident. Now, between this period, he has purchased some shares in December 2013. December 2013 means 13-14. Was he resident in that year? No. In December 13, he was not resident. Even today, he is not resident. Therefore, he cannot be called an assessee. We cannot charge him on this particular asset. Because in 13-14 also he was non-resident, today also he is non-resident. We cannot charge this asset. Second, he has purchased some apartment in London in 2015. So in 2015, that is 15-16, he was resident, and even today he is non-resident, it doesn't matter. But in the year in which he has purchased the apartment, that time he was resident, therefore you can charge this for an asset. Third, in 21-22, he has some manufacturing factory in Malaysia for establishing leather goods. This also cannot be charged because he was not resident in 21-22. He was resident till 2021. He was resident in 2021. He was not resident in 21-22. So in 21-22 also he was not resident. Today also he is not resident. Therefore, you cannot charge his income. Next, he has also earned some commission from 2014 to 2021. So commission income is chargeable in the year to which it pertains. But 14-15 you cannot charge because 14-15 black money law was not there only. Yes, commission income from 15-16 till 21-22 you can charge. From 15-16 to 21-22 you can charge the commission income because the income is chargeable in the year to which it pertains, and if the year pertains is prior to 15-16, then black money law cannot be charged. But if the asset pertains is prior to 15-16, black money law can be charged because asset is charged in the current year. I hope it is clear to all of you. So this is what this question is all about. Now question number 4, a DTAA question. Very good DTAA question. Very good. Lot of small informations are there in this question. Be very careful. First of all, you are supposed to compute total income and tax liability of Mr. Mahesh as per new regime. 115 BSc. Let's see what all things are there over here. First of all, Mahesh is 50 years old. New regime you are following. Salary 23 lakhs before standard deduction. So claim standard deduction 75,000. First of all, write salary. Next, self-occupied property. Self-occupied property, interest not allowed in 115 BAA. 115 BSc it is not allowed. In new regime, self-occupied interest is not allowed. Then, fixed deposit interest you can claim under IFRS. Income from business, $25,000. How will you convert this $25,000 into rupees? You will convert this as per Rule 115. What does Rule 115 say? You have to take TTBR on the last day of the financial year. What is the TTBR on the last day of the financial year? It is 71. So you have to convert this as per 71. So multiply this by 71. Similarly, income from house property 4,500 minus 450. That also you will convert as per last day of the financial year TTBR as per rule 115. Then dividend income. For dividend income, rule 115 says something else. For dividend income, you have to convert dividend income into INR as per the TTBR of the last day of the preceding month in which the income is earned. The income is earned in March 26, so you have to take TTBR of 20th Feb. Therefore, on 20th Feb, the TTBR is 70 rupees. You have to multiply by 70. Same for STCG also. You have to take TTBR of the last day of the preceding month. After doing all these things, you will compute your total income and you will compute your tax. Let's see. Salary 22,25,000. House property you will take and convert. Self-occupied house property interest not allowed. Business income you will take. Short-term capital gains you will take. 1,60,000 FD interest you will take, and 1,70,000 dividend income you will take. After that, you will get a total income of 54,11,290. On that, you will apply the slab rates. After applying the slab rates, you will also apply 10% surcharge because the income is more than 50 lakhs. Therefore, apply 10% surcharge and 4% cess. You will get your total income and tax as 13,76,000. On that 13,76,000, you will divide this by what? You will divide this by 54,11,000. Therefore, you will get average rate in India. Now, this average rate in India, you will apply on doubly taxed income in India. What is doubly taxed income in India? The doubly taxed income in India is 2,01,000 is doubly taxed, 17,75,000 is doubly taxed, 3,50,000 is doubly taxed, and 7 lakh is doubly taxed. On this, you will apply this 30,26,285. This is doubly taxed. This is the tax paid in India. Now, you will compare that with foreign tax. In foreign country, you are paying how much tax? You are paying 20% tax in foreign country, but be careful. In foreign country, you are not getting this municipal tax deduction. Therefore, in foreign country, you are paying 20% tax on 25,000. You are directly paying 20% tax on this 4,500. You are directly paying tax on this 10,000, and you are paying tax on this 5,000. Therefore, in foreign country, you are paying 20% tax on $44,000. If I total all these four, you will get 20% of 44,000 rupees, approximately $44,000. So on that 44,500, you will take 20%. Whatever amount will come will be your foreign tax. On that, you have to convert that into rupees now. How will you convert your foreign tax into rupees? You need to check when it is paid. It was paid by Mahesh on 25th of May. So now you will convert this foreign tax into rupees as per rule 128. See, to convert foreign income into rupees, you have to apply rule 115. But to convert foreign tax into rupees, you have to apply rule 128. And what does rule 128 say? You have to convert as per TTBR on the last day of the preceding month in which the tax is paid. The tax is paid on 25th May. So the last day of the preceding month is 72. So now you will multiply this entire tax. 44,500 is your total income in foreign country. 20% is the total tax in foreign country. Multiply by 72. That will give you your tax paid in foreign country. So the tax paid in India is 769. Tax paid in foreign country is 640. Therefore, whichever is lower will be allowed as a relief. And the balance amount you have to pay from your pocket. I hope it is clear to all of you. Let's move on to the next question. Question number 5. What is this question, sir? This question is on rollback provision. Do you know that you can make an application for APA for future 5 years and rollback for past 4 years? So you have made an application for what? Rollback on 50, application for APA on what? 15th of February 2025. So on 15th of February 2025, you are making an application which was signed on 5th of May 2025. Now you have been asked a question that can you roll back the agreement for the past years? So for first year 2020-21 you cannot roll back because you can roll back only for 4 years, and 2020-21 is beyond 4 years. Even for 21-22 you cannot roll back because you can roll back only for 4 years, not beyond 4 years. Yes, for 22-23 you can definitely roll back. There is no dispute, and assessment have been completed. Even if the assessment has been completed, you can roll back. There is no condition that if the assessment is completed you cannot roll back. There is no condition like that. Now the next one, in next year 23-24 the TPO has enhanced your income by 500 lakhs. See, one of the conditions that you cannot roll back is if your income falls below what the income declared in the ROI. So whatever is the income declared in ROI, because of rollback your income cannot go below that. So if I have told you in the class also, suppose in your ROI the income is 100 lakhs and if the TPO increases to 120 lakhs and after rollback it becomes 90 lakhs, then you cannot go for rollback. Your rollback cannot reduce your income below ROI. But yes, if you accept that I am ready to declare 100 lakhs as my income, then you can roll back. In this case also, the TPO has increased by 500 lakhs. The income can reduce below 500 lakhs also, but it should not reduce below what? The income which is declared in the ROI for AY 23-24. Similarly, for 24-25, can I go for rollback? Let's check what has happened. The matter has been to tribunal. The matter has been to tribunal for 24-25, and tribunal has set aside the case for fresh consideration by the AO, yes, you can go. Remember, if the tribunal has already passed an order discharging the matter at its end by confirming the order, by annulling the order or by modifying the order, then you cannot go for rollback. If the tribunal has closed the matter, then you cannot go for rollback. But if the tribunal has remanded back the case to AO, then you can definitely go for rollback in this case also. And for last year, you cannot go for rollback because you have filed the return late. One of the conditions for going rollback is you should file the return on time. If you file the return late for earlier years under 139(4), then you cannot go for rollback. I hope it is clear to all of you. So this is what this question is all about, and this is what this RTP is all about. Now somebody is saying this session already taken you yesterday, that was in Hindi. This is in English. Okay. So we take all sessions in both the languages. I am the only teacher who actually takes care of my full English students. Sir, why don't you take revision for CA Enter? You are blind. You don't have eyes. You go and check the YouTube. Yesterday evening only I took a revision for CA Enter. Go and check. Now you cannot make a demand that on 24th of March at 11 o'clock in the morning, you should take the revision for English also, Hindi also, Inter also, Final also. Everything at one time I cannot take. I am a human being. I am not God. Okay. Your demands are very, very unrealistic. That not 11 o'clock on 24th of March, you should take Hindi also, you should take English also, you should take Marathi also, you should Telugu also, Tamil also. Everything you should take at one time only. That is not practically possible. Go and check CA Inter revision video. Yesterday evening only I have taken, capital gains fully completed. Go and check. Check first and then comment. Have some audacity to check first and then comment, please. Don't do this. It is very wrong. I am putting lot of efforts. Not easy. Tell me which teacher is taking in both the languages across the country. Give me one name. Give me one name. I have already shared CA Inter student, whomsoever you are. Go and check my Telegram channel. I have already shared the schedule. Read that completely and then come here and ask, please. Let's move on to next RTP, RTP November 2024. Now, what is given in this RTP? Again, a total income question has to be computed in the most optimum income tax liability. Again, you have to compute as per normal provision, then as per MAT, and then as per 115BAA, just like the previous RTP. Okay. So let's start with the question. The very first item which is given over here, associate is engaging manufacturing of pharma product, pharma product, pharma product. This is very important line. The pharma product is very important line. Some adjustments are related to pharma over here, which is given in this question. First thing which you are doing, you are incurring 6 lakh rupees as a public issue expenses that will not be allowed as a deduction. Any expense incurred for issuing shares not allowed, even though the public issue could not be materialized due to non-clearance by SEBI. It doesn't matter. Any expense which is incurred with respect to what public issue, share issue, it's a capital expenditure, therefore it is not allowed as a deduction. Be very careful. Okay. The next adjustment is also a new adjustment. You are purchasing some goods of 5 lakh rupees from a micro enterprise Sunny Traders on 25th of February 2026, and you have made a commitment that I will make the payment in 25 days. So if you purchase anything from micro or small enterprise, and if you make a commitment that I will make the payment in 25 days, if you make the payment within time, then the expenditure will be allowed on accrual basis. But if you make the payment beyond time, then the expenditure will be allowed on payment basis. Now, if you make a commitment that I will make the payment in 25 days, now you are making the payment on 29th March 2026, which is beyond 25 days. So you will be allowed the deduction on payment basis, not on accrual basis, because you are not making the payment on time, you are making the payment late. But even though you are making the payment late, still the payment is made in the same financial year. Therefore, no need to worry, you will get the deduction in the current year itself. Yes, if this 29th March would have been 3rd April, then you would have been given the deduction in the next year, 26-27. Now, because this 29th March is also in the same financial year, you can claim the deduction in the current year, no issues. Okay. Third one, you are a pharma company, you are giving freebie to medical practitioners, not allowed. Pharma company giving freebies to doctors, medical practitioners, medical associations, not allowed as deduction. Next one, it is disallowed under explanation to section 37(1). Depreciation as per books of accounts, disallowed. One-time license fee you are paying for obtaining a franchise, then that is disallowed, and on that you can claim 25% additional depreciation later on. Okay. Next one, you are setting up some warehouse in rural area for storage of agriculture produce. Now this is eligible for 3580 deduction. Now on that there is a profit of 17 lakh rupees. So do one thing, show this profit separately. Don't merge this profit with your pharma business. So reduce from here and show under PGBP separately. Next one, you are receiving some power subsidy that is considered as a revenue income. Therefore, let it be part of income. Write a note that power subsidy is an income as per section 2, clause 24, subclause 18. It is deemed to be income under section 224(18). Next one is your again grandfathering clause. I am irritated with this grandfathering clause. Again and again it will come. 4,80,000 is your profit. Whenever 31st Jan 2018 will come, it means it is a grandfathering clause. 4,80,000 is your profit from shares on which STT is paid. So that profit you will reduce from PGBP, and under capital gains you will compute separately whatever capital gains will come. How will you compute? You will compute the cost separately. Cost will be actual cost compared with lower of FMV on 31st Jan 2018 or share or selling price, whichever is lower. Compare that with actual cost and then whichever is higher. That will be your cost. Okay. Now next one is also a very, very intelligent adjustment. Now one thing you need to remember in point number H, whatever capital gains will come, on that 12.5% tax will be imposed. In excess of what? In excess of 1,25,000 rupees, because it is covered in 112A. Next, you have taken a loan from Punjab National Bank of 8 lakh rupees. Now, that loan is taken for working capital requirement, and that loan is waived off by the bank. In that, there are two parts. 6 lakh is your what? Is your principal, and 2 lakh rupees is your interest. So whatever principal is waived, now entire 8 lakh rupees you have credited to what? P&L account. Now that on that principal which is waived, that is considered to be your income. Why? Because it is remission and cessation of a trading liability. Therefore, that principal will be subject to tax. What about interest? Interest will not be subject to tax. Why? Because interest as an expense was not allowed as deduction because of 43B. Because as per 43B, if you take a loan from PNB, interest is allowed on payment basis. Because the interest was disallowed earlier, therefore again on waiver of interest, it cannot be subject to tax. Therefore, reduce interest what? From your PGBP income, and let principal be part of your income. Principal will be subject to tax. Next one is you are employing 50 employees in the financial year 25-26 on a regular basis. They participate in the recognized provident fund. Then emolument is also less than 25,000 rupees. You are employing them for also more than 240 days. Therefore, you will be eligible for what? You are also making the payment by account paycheck. Therefore, you will be eligible for 80 JJAA year. 50 employees into 23,000 into 9 months, because from July into 30%, 80 JJAA deduction will be available. Next, for warehouse of agriculture, for warehouse of sugar, you have invested 40 lakh rupees. Out of that, 25 lakh is land. Therefore, 15 lakh rupees will be allowed as deduction under 3580. So, under 3580, what will be your income? You have already shown 17 lakh as a profit. From that, 15 lakh rupees you will claim as a deduction. Therefore, 2 lakh rupees will be taxable profit under 3580. Last but not least, your depreciation as per income tax law is how much? 9,20,000. You can claim that as deduction. Your turnover of last year is 395 crores, which is less than 400 crore. Therefore, 25% tax will apply, surcharge if applicable, and cess. Now you will compute tax as per what? Tax as per book profit. 115 JB, 99.5 lakhs is your book profit. Therefore, 15% tax and 4% cess. No surcharge, because income does not exceed 1 crore rupees. Now you will compute optimum tax. For that, you will compute 115BAA. What is different in 115BAA and normal provision? Only one thing. Whatever 3580 deduction you have claimed, 15 lakh rupees, you will add back that 15 lakh rupees, and on that 15 lakh rupees, that is a building, on that 15 lakh rupees, you will claim what? Normal depreciation of 10%. That's the only thing which is different under 115BAA and normal provision. So in 115BAA, what are you going to do? Add back the depreciation, add back the 3580 deduction of 15 lakh, and on that you will claim your normal depreciation of building of 10%. Okay. After that, you apply on special income, you apply special rate. On normal income, you apply 22% tax, 10% surcharge, 4% cess, and whichever is more beneficial, go for that. If normal provision is beneficial, go for that. If 115BAA is beneficial, go for that. Whichever you are comfortable, you go for that. Okay. I hope it is clear to all of you. Now, question number 2. Question number 2 is one of the best questions that I have come across till now. I am not saying in the entire 26 paper. There are much better questions which will come later on. But question number 2 is one of the best questions that we have come across so far. It's a question on partnership firm XYZ and company. There are 3 partners, A, B, C, who are working partner, and there is 1 non-working partner. So total there are 4 partners, and their details are given, and you are supposed to compute two answers. First, the firm do not want to get its books of accounts audited. Advise the firm on its total income. Firm does not want to get the books of accounts audited. You want to compute the total income of the firm. How will you compute the total income of the firm? See, audit is not required. They don't want to do audit. Now, the turnover of the firm is 2 crore 80 lakhs. Be careful. Can the firm go for 4480? Yes, they can go. Generally, if your turnover is more than 2 crore, but up to 3 crore, you can go for 4480 only if your cash receipt is up to 5% of your total turnover. So, if your cash receipt is up to 5% of your total turnover, you can go for 4480. Let's check the cash receipt and the total turnover. If it is within 5% range, they can go for 4480, and if they can go for 4480, there is no audit required. So therefore, what is the cash receipt? The cash receipt is 2 lakh over here. 2 lakh is cash receipt, and this 10,50,000 is also cash receipt. This is cash receipt directly, point number 3. And point number 4, receipt by way of a check other than account paycheck. If you receive by other than account paycheck, that is also considered as cash only for the purpose of 4480. Go and check. It is written in 4480. Any amount received other than account paycheck will be considered as cash. So total cash receipt is 12.5 lakhs. And what is your total turnover? 280 lakhs. This is 4.46%. Therefore, you are well within the range of 5%. Therefore, you can go for 4480. Therefore, audit not required. Now, compute income as per 4480. On cash portion, 8% deemed income, and on other than cash portion, 6% deemed income. From that, you can claim brought forward business losses. In 4480, you cannot claim any deductions from 28 to 44, but you can definitely claim losses. Therefore, from this amount of 4480 income, you cannot claim remuneration interest paid to partners. That is not allowed. 40B is not allowed from 4480. But yes, business losses are allowed from 4480. After that, you have to show one thing extra, that is capital gains. 57 lakh is the sale of land, and 12 lakh is the acquisition of the land, cost of acquisition, which has been purchased 5 years back. Indexation not available after 23rd July 2024. Therefore, 57 lakhs minus 12 lakhs, 45 lakhs will be your capital gains, and this 45 lakhs is your capital gains, and this is your PGPP income. This is your part 1. Check it, please. This is your PGPP income. From that, 75,000 business loss is set off, and 45,000 rupees capital gains. From that, GTI will come. Okay, this is your part 1. Now, part 2, very intelligent. Again, compute total income, assuming that instead of 2 lakh received from firm, 4 lakh is received by check other than account paycheck. Let's assume that this is not 2 lakh, this is 4 lakh. So now, if this is not 2 lakh, this is 4 lakh. Therefore, total cash receipt is 14.4 lakhs. So if the total cash receipt is 14.4 lakh, now if you do 14.4 lakh divided by 280, it is going beyond 5%. Now, because it is going beyond 5%, now you cannot claim 4480. 4480 cannot be claimed. Now you have to compute total income as per the normal provision. You have to compute total income as per the normal provision. So start computing total income as per normal provision. The net profit is 8,65,000 after debiting and crediting the following items. The first item that you are going to add back, net profit 8,65,000. Now 4480 not available because your cash receipt is more than 5%. So 8,65,000 is your net profit. Interest 15% not allowed. Add 3% back first. Item number 1 to add back is interest. Then 60,000 remuneration you are paying to all the partners. So there are 4 partners, to all of them you are paying remuneration. Add back entire remuneration. 60,000 into 4 partners into 12 months. Add back the entire remuneration. Then what else to add back, sir? Third item, you have to reduce the profit. Profit you have credited to P&L. Capital gains you have credited to P&L. So reduce that 45 lakhs from P&L account. Then, sir, one more item. You are making some payment of 12,000 rupees cash payment to a clerk which is debited to P&L. Rest all does not exceed 10,000, but clerk payment is exceeding 10,000. So 12,000 into 12 will come to 1,44,000. So 4 adjustments you are supposed to make. Which 4 adjustments? The interest you have to add back 3%. Remuneration you have to add back all 4 partners. Clerk salary you have to add back 144, and then you have to reduce your capital gains of 45 lakhs. After that, there is a book loss. That is a book loss. So if there is a book loss, not book profit, then how much remuneration you can claim as a deduction? Maximum 3 lakh rupees, not more than that. So your maximum limit is 3 lakh, but your actual remuneration is 21 lakh 60,000. How, sir? For 3 working partners, 60,000 into 12 into 3 working partner, actual remuneration 21 lakh. But in case of loss, you cannot claim more than 3 lakh. Therefore, 3 lakh you can claim as a loss. Therefore, ultimately your business loss will come to 881. Already 581 is your loss, and 3 lakh more loss because of the remuneration. 881 is your loss. Now you can set off this loss against your capital gains income. Yes, you can set off. PGBP loss can set off against capital gains income, but capital gain loss cannot set off against PGBP income. PGBP loss you can definitely set off against capital gains income. Sir, what about last year 75,000 loss? That you cannot set off against capital. That you cannot set off against capital gains income, because last year business loss can set off only against current year business income. But current year business loss can set off against any other loss, any other income except salary. Last year business loss cannot be set off against current year capital gains income. Last year business loss can set off only against current year's PGBP income. And in current year there is no PGBP, there is already a loss. Therefore, that 75,000 you have to carry forward. I hope it is clear to all of you. Question number 3 is a very simple case law question. There is a telecom company and you are a distributor. And I am giving you SIM card, I am giving you recharge coupons, and I am selling you SIM card and recharge coupon. There is no principal-agent relationship. There is a principal-principal relationship. So if there is a principal-principal relationship, 194H will not apply. If there is a principal-agent relationship, then 194H will apply. That is what it is mentioned in this particular question. Check it, please. Question number 4. Again, a very simple question. The assessing officer is doing a survey in the night at 9:30 p.m. in a sports complex. The sports complex is open between 5 a.m. to 10 p.m. So the first question is, can he enter in the night? See, there is a provision in the survey section in 133A that the assessing officer can enter for survey provided he has taken an approval from higher authority like Principal Director General, Principal Chief Commissioner and Commissioner. Let's assume that he has taken the approval. The question does not specify about approval. Let's assume that he has taken an approval. Let's assume that he has taken an approval, and approval is not a concern. Now let's talk about the timing. Can he enter after sunset? There is a provision in survey section that the officer can enter only after sunrise but before sunset. But there is further a provision that if the business hours is in night, then he can enter in the night also. What is the business hours? The business hours is from 5 a.m. to 10 p.m. and he is exactly entering half an hour before the business hours end. Therefore, he can enter. There is nothing wrong in that. Second thing, can he after entering take away books of accounts and cash? Books of accounts and cash. So there are 2 things which he wants to take away. One is cash, one is books of account. Let me talk about cash. Cash he cannot take away. In case of survey, he cannot take away cash under any circumstance. Yes, for books of accounts, he can take away the books of accounts for as much time as he wants. For as much time as he wants, he can take the books of accounts. But if he wants to take the books of accounts for more than 15 days, excluding holidays, then he has to take approval from higher authority. Cash he cannot take. Books of accounts he can take up to 15 days. No worry, beyond 15 days, he can take an approval and take beyond 15 days also. Okay. Next question, question number 5. A very simple question. Penalty. There is an investment fund under 9A. Sir, what is investment fund? We have done in the chapter of non-resident taxation. Then hopeless section is there. There is an investment fund outside India. There is a fund manager in India. They have to fulfill 17 conditions. 13 conditions should be fulfilled by the fund. 4 condition has to be fulfilled by the manager. Then the income of the investment fund will be not subject to tax. So who will check whether these conditions are fulfilled or not? For that purpose, investment fund has to file a statement in Form 3CK within 90 days from the end of the financial year. So they have to file a statement in Form 3CK by 29th of June 2026. If they don't file a statement under Form 3CK, then they will be liable for penalty of 5 lakh rupees under 271 FAB. That is what it is mentioned over here. So what is the penalty for not filing the statement within 90 days? It is 5 lakh rupees under 271 FAB. I hope it is clear. Second question over here is also very simple. There is a caterer who is receiving 1 lakh in cash and 9 lakh account pay check, so no issues. Because you are receiving only 1 lakh in cash, if you receive 2 lakh or more in cash, then the provision of 269 ST will apply, 271 D apply. Because here you are receiving only 1 lakh in cash and 9 lakh by account pay check, no penalty will be imposed under 271 DA in your hands, and no 269 ST will attract in your case. I hope it is clear to all of you. Question number 6, very dangerous question. Very, very, very dangerous question. This is the best question on DTAA across the book. Best. No DTAA question can be better than this. First of all, Mr. Rakesh or Mr. Ram Prakash, whomsoever it is a resident. You need to compute the income as per and tax liability as per new regime 115 BSE. And Mr. Rakesh and Mr. Ram Prakash, whomsoever it is, he is earning income from 3 countries, country X, country Y and India. Let's compute total income in India. When you compute total income in India, you will take house property 2 lakh 50, 2 lakh 50, 5 lakh minus 30% standard deduction. Then all these losses will be set off against all this PCPP income of 2 lakh 80, 3 lakh 40 and 1 lakh 80. 10 lakh 80,000 STCG will go in short-term capital gains. 37 lakh long-term capital gains on sale of house. And to save that long-term capital gains, you have purchased another house within 1 year, that within 2 years in the name of your spouse, joint name with your spouse. Can you purchase a new house in the name of your spouse? Yes, why not? The Delhi High Court in the case of Kamal Wahal has held that you can purchase another house, another residential house in the name of your wife. Your wife is not a stranger. You can purchase. So far as the consideration is invested by the SSC, you can claim. Then 3,40,000 agriculture income will be taxable in India. Foreign agriculture income is not exempt. Indian agriculture income is exempt. 1,80,000 agriculture income from country wise is also taxable. Yes, 5,20,000 agriculture income will not be taxable in India. So everything will come in the total income except this Indian agriculture income. Everything will come in the income. And from rental income, you will claim 30% standard deduction. I hope it is clear to all of you. After doing all this thing, you will get your total income. Total income 37 lakh. Now you have to compute tax. How will you compute tax? Don't compute tax directly on 37 lakhs. You are gone. There is an agriculture income. You have to apply partial integration. Step number 1, compute tax on 37 lakh plus agriculture income. So compute tax on what? 42.2 lakhs. Step number 1, compute tax on agriculture income and total incomes. Compute tax on 42.2 lakhs. Now, while computing the tax on 42.2 lakhs, be very careful. Out of this 42.2 lakhs, 12 lakhs is long-term capital gains. Therefore, on long-term capital gains, compute 12.5%, and on other income, compute as per slab rates. That is your step number 1. Step number 2, compute tax on agriculture income plus basic exemption limit. Agriculture income is 5.2 lakhs, basic exemption limit is 4 lakhs. Now compute tax on 9.2 lakhs. This is your step number 2. Now step number 1 and 2, difference, take the difference between step number 1 and 2. Step number 1 minus step number 2 will be your ultimate tax. On that apply cess. No surcharge because the total income is less than 50 lakhs. Apply cess and then you will get your tax, and then you will divide this by 37 lakhs and therefore you will get your average rate in India. The average rate in India is 16.98. Now compare this average rate in India with foreign average rate. Now in country Y the average rate is 27%, but in country X the average rate is not given. They have given the slab rate. So for country X we need to first of all find out the average rate. How will we find out the average rate in country X? For country X we need to find out the average rate by taking country X total income in the denominator and then computing tax as per the slab rates and taking that tax in the numerator. So what is country X total income? Let's try to understand what is country X total income. Try to understand, please. Pay attention, please. Sir, will this 2,50,000 come in country X total income? Yes, 2,50,000 will come in country X total income. In country X, you will not get any 30% standard deduction. Sir, will I reduce this 1,20,000? No. In country X, this loss is not allowed. Check. Not in country X. Loss from cannot be set off in country X. Therefore, in country X, do not set off. Sir, will I take business income? Yes, take business income in country X. Sir, STCG, yes, take STCG in country X. And sir, agriculture income is exempt in country X. So don't take country X agriculture income. In country X, you don't pay tax on agriculture income. Therefore, country X only 3 income will come: 2.5 lakhs, 2.8 lakhs, 10.8 lakhs. This is your denominator. On this denominator, apply this slab rate. You will get the tax. After you get the tax, you will get the average rate. Now that average rate you will compare with Indian rate, and now you will compare the average rate, whichever is lower, and now you will apply that on doubly taxed income. So what is doubly tax income in case of country X? In case of country X, doubly tax income is not 2,50,000, it is 2,50,000 minus 30%. Then in case of country X, doubly tax income is this 2,80,000, this 10,80,000. This is not doubly tax income, and this 1,20,000 rupees you have to reduce, because on that 1,20,000 you are not paying tax in India. Similarly, doubly tax income you have compute in the same manner the way you have been computing earlier also. 2,50,000 minus 30% is doubly tax income, then 1,30,000, then this. And in country Y, agriculture income is taxable. Therefore, in country Y, this 1,80,000 is also what? Is doubly tax income. Country X only agriculture income is exempt. In country Y, it is taxable. Therefore, in country Y, this 1,80,000 is also doubly tax income. Very, very great question. No question can be better than this in the entire 26 paper. They cannot ask you such question, such big question in the same manner. They have to reduce the content and then ask. Such a big question, if they start asking in the examination, students will go mad. They cannot ask such big question in the examination. It is very, very, very big. Next question. Question number 7, which is on poem. There is a foreign company which is located in USA. Their global assets are 50 crores and their Indian assets are 25 crores. Now, if they pass ABOI test, then their poem is outside India. But the first condition of ABOI test is what? The second condition of ABOI test is failed. What is the second condition of ABOI test? The Indian assets should be less than 50% of total assets. Now, Indian assets are exactly 50% of total assets. Therefore, ABOI test is failed. Further, one more condition is there, that there are 10 board meetings are held, out of which only 4 are held in India. But major commercial decisions are made in India only. Now, this is sufficient evidence. They are failing the ABOI test and majority of the big decisions are taken in India. Therefore, poem is in India. Therefore, this foreign company is a foreign company, but at the same time, it is resident also. It is a foreign company as well as it is a resident. Now I am making a professional fees payment to this foreign company. I am making, say, 10 lakh rupees professional fees payment to this foreign company, which is a foreign company as well as resident. So now I will deduct TDS as per what? 194J or 195? Because in 194J it is written, if you make the payment to resident, then you should deduct TDS. Yes, this is a resident company. Then 195 it is written. If you make a payment to foreign company, you should deduct TDS. Yes, it is a foreign company also. So if there is a clash between resident and foreign company, for the purpose of TDS, what should I consider? So the CBDT has given a circular that if there is a clash between 194J and 195, if there is a clash between resident and foreign company for the purpose of TDS, consider this as a foreign company and tell them to fulfill all the related requirements also, like you have to deduct TDS as per 195 and also you have to fill form 15 CA, 15 CB, all the related formalities also you have to fulfill. I hope it is clear to all of you. Next question. It's a very simple question. There is an Indian company which is located in SEZ, in which a foreign company holds 30% share. Therefore, both of them are deemed to be associate enterprise. Now you have to compute the arm's length price in 3 different transactions. Now you are selling 90,000 pieces at rupees 10 to your associate enterprise. To third party you are selling at 12 rupees. So to associate enterprise you are selling at lower price. To third party you are selling at higher price. Therefore, how much higher? $2 higher. So 90,000 pieces into $2 into 85 rupees. That will be your addition in the arm's length price. Second, you are paying some guarantee fee of 15,000 rupees to associate enterprise. To third party you are paying only 12,000. Therefore, 3,000 extra you are paying. So $3,000 into 85 rupees will be your increase in arm's length price. Third one, you are taking some details of potential customers and you are paying 18,000 rupees to your associate enterprise. To third party you are paying only $16,000. So $2,000 extra you are paying to your associate enterprise. Therefore, that $2,000 will be added to your arm's length price. $2,000 into 85 rupees will be added back. So these are the adjustments which will be made as per point number 1. Point number 2 says that if such adjustments are made by AO, can you claim deduction under 10AA on the enhanced income? No. If the AO increases the arm's length price, then as per 92C subsection 4 first proviso, the AO increases the arm's length price, then you cannot claim profit link deduction, you cannot claim chapter 6A on that income, and you cannot claim 10AA on that particular income. So this is what this particular paper is all about. So I will stop here. Here we have completed 5 revision of RTPs. Now 4 more RTPs are pending, which I will revise day after tomorrow. Okay. So day after tomorrow, I will revise another 4 papers. So till then, take care all of you. Bye. Take care.